Good evening, everyone. Can you just let me know if I'm audible enough? Okay. So, in today's class, I'll be discussing the 2023 A-Level paper part 1. Okay. Then starting off with the first question, which of the following statements best describe the primary purpose of accounting? Okay. So, whenever they ask the primary purpose of accounting, it should be providing information for stakeholders to make decisions. So, that is the third one here. You can easily identify that. Provides the information about a firm to the stakeholders for decision making. That is answer number 3. When you look at the other statements, records the transaction to prepare financial statement. That is one process in the financial accounting. Second one, prepare general purpose financial statement to meet legal requirement. That's the other sub-objective of financial accounting. When you take the fourth one, that's mainly focusing on management accounting. And the fifth one, provide information through financial statement for annual external audit. That's also not the main objective. Okay, so the most suitable answer should have decision making for stakeholders, right? So that is the third one. Then the second one, which of the following accounting concepts provide the basis to classify assets and liability as current and non-current? Okay, so we have studied this often. We divide assets and liabilities as current and non-current because of the going concern concept. The reason behind that I have already explained it in the old past papers, I think 2016 or 17. Third one, which of the following accounting concepts provide the basis for recognition of right of use asset in statement of financial position? So we record the lease asset as an asset in our SOFP because of what concept? Because of substance over form concept. Even though we do not legally own it, because we have the control of it, we have to recognize that as an asset based on substance over form concept. Then moving on to 4, 5, and 6. Mihiri commenced a trading business on 1st of January 2023 by investing 500 in cash. Okay, they had given a few transactions. You can start with reading the question. Fourth one, what are the source documents used to record transaction 1, 2, 3 in the books of Mihiri? Okay, so in the books of Mihiri, now this is Mihiri's business. 1, 2, 3. First one, purchase goods costing 400,000 on credit. So that will be invoice. Source document will be invoice. Return 30,000 goods purchased from Deshan Traders. So purchase return, the source document will be, the source document for purchase return will be debit note, debit note, debit note. Then the third one, sold goods costing 250 for 345 on cash. So that will be receipt, receipt. Invoice, debit note, and receipt. That will be answer number 3. Yes. Then the fifth one, what are the prime entry books used to record the initial investment of Mihiri and the transaction 3 and 5? Now, what are the initial investment? Mihiri commenced the trading business by investing 500,000 in cash and furniture worth 400,000. So for the cash investment, that will be cash receipt journal, cash receipt journal. And for the furniture, that will be general journal, general journal. So they are for initial investment and transaction 3 and 4. Third one is a cash sale, that will be cash receipt journal. And Fourth one, it's no, what are they asking? 3 and 5. Fifth one, issued a check to settle the payable to Deshan. Cash payment journal. So the answer will be cash receipt journal, general journal, cash receipt journal, and cash payment journal. That is answer number 4. Answer number 4. Okay. Sixth one, which of the following accounting equation reflects the net impact of transaction number 3 and 4 in the asset? Okay, in the equation asset equals liability plus equity, 3 and 4. Third one, sold goods costing 250 for 345. Okay. So inventory minus 250. You're selling it for 345 on cash. Therefore, cash will be plus 345. This includes the VAT of 45. Sales VAT is a liability. Therefore, liability plus 45. Liability plus 45. And then now here, if this cash amount includes a VAT of 45, the how much will be the selling price? Selling price will be 300, right? Selling price is 300. Cost of the good is 250. Therefore, there is a profit of 50. Equity plus 50. Okay. Then fourth one, they're saying to find the impact on transaction number 3 and 4. Fourth one, sold goods costing 100,000. Okay. Goods minus 100,000 for 138,000 on credit. Then debtor plus 138. This includes the VAT of 18,000. Then liability plus 18. Now the debtor should totally pay 138. It includes the VAT amount of 18, which means the selling price is 120, right? The debtor's full amount minus VAT. The selling price is 120. The cost of the good is 100. Therefore, there is a profit of 20,000 there, plus 20 equity. So when you balance this off, you can find the net impact of the transaction. That will be, give me 345 minus 250 plus 138 minus 100, that is 133, 63 and 70. Answer number 5. Answer number 5. Okay. Then the seventh one. The profit shown in the draft financial statement was 360,000. And they are telling to correct these errors and find the correct profit for the year. Okay. So firstly, you can write the drafted profit. Drafted net profit 360. Now you can correct the errors. The surplus of 120,000 resulted from the second time revaluation of motor vehicle during the year has been recognized as other income. Now surplus from revaluation is not other income, right? That is other comprehensive income. So we do not include that in profit. Other income is added to profit, right? Then what you have to do, you have to remove this surplus from your drafted profit. Minus other income. They recorded as other income, right? Minus other income 120. However, this surplus has been accounted without considering the revaluation deficit of 80,000 recognized for motor vehicle in the previous year. Last year, there was a deficit of 80,000 when revaluing motor vehicle. This year, there is a surplus of 120,000 when revaluing for the second time. So what we have to do, that last year deficit, we can set it off under other expense, right? What we have to do, 80,000, we have to deduct from other expense. We have to deduct other expense by 80,000 means our profit will increase by 80,000, right? If we are deducting an expense, profit will increase. So plus other expense, the deficit amount, you can add it 80. Then only the remaining 40,000 will go to other comprehensive income. Okay. Then the next one. The maintenance expense of the photocopying machine relevant for the current year 30,000 was paid on 1st of October to 1st of April 2022, and it has been debited to the office equipment account. Maintenance expense, that is an expense, right? You don't add it to office equipment. So what you have to do, you have to deduct that maintenance expense. You have to record it as an expense. Maintenance expense 30,000. Now what they have done, they have debited it to office equipment account and they are providing depreciation 20%. Now if they have recorded this 30,000 in the office equipment account, they would have given depreciation for that, right? So we have to remove that depreciation. So you have to add back the depreciation expense for that maintenance expense. So depreciation 20% of 30,000 is 0.2 into 30, that is 6,000. Okay, so they have deducted 6,000 as depreciation expense extra when they are calculating their net profit. Then you have to reverse it by adding that depreciation back. Then you can get your corrected net profit. Your corrected net profit will be 360 minus 120 plus 80 minus 30 plus 6. 296,000. That is answer number 5. Okay. Then 8th one. Aruni Traders is a sole proprietorship during the year ended 31st March 2023 and inventory costing 20,000 was fully destroyed. Okay. And 80% of this loss was reimbursed by the insurance company. No adjustment have been made in the books of account for the loss of inventory and the insurance claim. Okay. However, the closing inventory has been ascertained based on physical stock available. All right. And they have given the gross profit and net profit before considering this. So they have given us the wrong gross profit and net profit. Gross profit and net profit. Okay. So the gross profit they have calculated is 150. The net profit they have calculated is 80,000. So now what has happened? 20,000 worth of inventory is destroyed. Okay. So what you have, and also stocks are counted based on the physical count. So what you have to do, if the stocks are ascertained based on physical stock count, you have to deduct the damaged stock from the cost of sale. So if you are deducting 20,000 under cost of sale, that means your gross profit will increase by 20,000, right? If the cost of sale is decreasing, gross profit will increase. Okay, so you have to add 20,000 stock damage to gross profit. Now, whatever affects the gross profit will automatically affect your net profit as well. So if the gross profit is increasing by 20,000 because of the damaged stock, net profit also will automatically increase by 20. Next, you have to consider the stock loss. Now here, the damaged stock is 20. Out of that, 80% the insurance company is reimbursing. Then how much will we get from the insurance company? 80% of 20,000 is 16. 16 we will get from the insurance company. Now the damaged stock is 20. Insurance company is going to pay you 16. Then the loss you're incurring from this is 4,000. This is your stock loss. This stock loss of 4,000 will reduce your net profit. Net profit minus 4. Then now your corrected gross profit will be 170,000 and your corrected net profit will be 96,000. So that will be answer number 5. Gross profit 170, net profit 96. Answer number 5. Then the 9th and 10th one. What is the prime cost? Okay. Aurelia PLC commenced its operation on 1st of April 2022. So this year only we started our manufacturing business. The year is ending on 31st March 2023. That means the year has started on 1st of April and that is when they have started this business itself. Then they have given some information. Okay, so now we'll start calculating our prime cost. Cost of raw material purchase 5,500. Raw material purchase 5,500. Okay, now see here, you will have to consider the additional information as well. Raw material costing 550 million, raw material costing 550 million were destroyed during the year. So destroyed raw material you have to deduct, and that will go as other expense in income statement. So raw material destroyed you have to remove. That will be 550. And then they are saying 20% of the raw material purchased remain as inventory as at 31st March 2023. So 20% of the raw material that we purchased here will be there in a closing stock, it seems. So minus closing raw material, that is 20% of what we have purchased, that is 20% of 5,500,000 is 1,100. Then you will get the raw material consumed as amount will be 5,500 minus 550 minus 1,100, 3,850. Then you have direct labor cost. Direct labor cost is 4 million. There is no direct other cost. And they are saying here, the second additional information, the work in progress as at 31st March 2023 was 450 million. Okay. And the work in progress is valued at prime cost. Now, work in progress can either be valued at prime cost or total production cost. Now, here in this question, work in progress is valued at prime cost. Then the closing, no opening work in progress because this is a newly started business. They have given the closing work in progress. You have to deduct it. Minus closing work in progress, 450. Then you can find your prime cost as, your prime cost will be 3,850 plus 4,000 minus 450, that is 7,400,000. 7,400, answer number 1. Then the 10th one, this is for the 9th one. 10th one is asking what is the total manufacturing cost. So for manufacturing cost, you will need the prime cost, 7,400. For that, you will have to add your production overhead cost. Now here production overhead cost excluding machine depreciation is given as 800. And for that, you have to add the depreciation of machine as well. How much will that be? Cost of machine purchased on 1st of April 2022 was 8,000. Useful life is 10 years. They have not given any residual value. Therefore, depreciation will be 8,000 divided by 10, that is 800. Then total manufacturing cost will be 7,400 plus 800 plus 800, that is 9,000 million. 9,000 million, answer number 1. Okay. Then 11 and 12. Okay, give me a minute. Okay, here's the working. Alright. So 11 and 12. To find the cost of sale, net profit and closing stock. Okay. So here they have given opening and closing balances of PPE, debtor, creditor, operating expense 250 relevant for the year has been paid in cash. Further 3 million was collected from debtor. 2,500,000 was paid to creditor. All the sales and purchases are carried out on credit basis. And they have purchased the PPE, and also they are selling goods with a markup of 25% on cost. Now for us to find our cost of sale, we'll have to find our sales value, and then we can find out, we'll find the sales value. Now here all the sales and purchase are carried out on credit, right? Then you can prepare a debtors account. To find your credit sale. And you can prepare your creditors account to find the credit purchase, your purchase value. So debtor opening and closing balances are given as 1,000 and 1,500, BBF 1,000, BCD 1,500. We have received cash from debtor. Here further 3,000 was collected from debtor. Cash 3 million. And when you balance off, you can find the sales amount. 4,500,000 minus 1,000, that will be sales will be 3,500,000. Then you can find your purchases through creditors account. Creditors BBF and BCD is given as 800 and 1,200, 800, 1,200. Then the cash paid to the creditor is given as 2,500, and you can balance this off and find the purchases value. 3,700 minus 800, your purchase value will be 2,900. Okay, then how are you going to find your cost of sale? That is, now here the entity sells goods with a markup of 25% on cost. So now, if the cost is 100%, on that only they will calculate the profit of 25% and decide their sales as 125%. Okay, if the profit is calculated on cost will be 100%. The profit is 25% on cost, then your sales will be 125%. Now the sales we found out as 3,500, then the cost will be 3,500 divided by 125 into 100, that is 2,800, which means our profit, the gross profit is 700. This is the gross profit. Okay. Then now we can find the cost of sale. Okay. Then this will be the cost of sale, right? Cost of sale is 2,800. That is answer number 5. Next, they are saying to find the net profit and closing stock. So how do you find the net profit? First of all, we'll find the closing stock, opening stock plus purchases minus closing stock will give you cost of sale. The opening stock value is 1,800,000. Opening stock value is 1,800,000. Purchases we found as 2,900,000. Cost of sale we found as 2,800,000. Then how much will be your closing stock? You can reverse and find 2,800,000 minus 2,900,000 minus 1,800,000. Your closing stock will be 1,900,000. Now, how to find your net profit? From your gross profit. Now, gross profit is given as 700. From the gross profit, if you minus your other expenses, now there is no any other income. See here, operating expense of 250 relevant for the year has been paid. So you can say minus operating expense paid 250. Okay. Now we have PPE, right? For PPE, we will have to provide depreciation. Do you think this operating expense paid amount includes depreciation? No, because they are saying here operating expense paid, the amount of expenses paid in cash. Depreciation we don't pay in cash, right? It's a non-cash expense. That means depreciation is not included in this. You will have to calculate the depreciation by preparing a PPE account. You can prepare a PPE account at net book value. At net book value means their depreciation is recorded in the PP account itself. Okay, it's calculated at carrying value. So opening PP balance carrying amount is 3000, BBS 3000. During the year, you have purchased the PPE of during the year, equipment cost in 2250 were purchased. So debit cash 2250. The closing balance of PPE is given as 5 million. Then when you balance off, you can find the depreciation amount 5250. 5250 minus 5000. Depreciation is 250 minus depreciation 250. Then you can get your net profit as net profit will be 200. So net profit 200, closing stock 1900. That is answer number 1. Answer number 1. Okay. Then 13th one. Which of the following statements are correct as per the section 24 of Partnership Ordinance of 1890? All the partners are entitled to share profit and loss equally. Correct. That is as per the section 24. A retiring partner is entitled to interest of 5% per annum on the amount due to him or her at the time of retirement. Is that as per section 24? Paying 5% interest on retired partner's loan is as per section 42, right? Section 42. In section 24, what they are saying? Provide 5% interest on loans of existing partners. Okay. See, every partner may take part in the management of the partnership, but not entitled to receive remuneration. That means a partner has to take part in managing the business, but he won't be entitled to any salary. That is correct. So A and C, answer number 3. 14 and 15. Current account balance, capital account, loan account balance of PL, need. Okay. So for all that, now here they have given capital current account balances. What we can do, we can prepare the partner's capital account and partner's current account. So we have PL, Lal and Neil. PL, Lal and Neil. PL, Lal, Neil. PL, Lal and Neil. Okay. So opening balances you can record BBS 6000, 4000, 2000. And all partners have a credit current account balance BBS 800, 600, 400. As per the partnership agreement, each partner is entitled to an annual salary of 800,000 and 10% annual interest on opening capital balance. Okay. So we can record that in the current account. Partner's salary 800, 800, 800. Interest on capital 10% of opening balance. Then 6,000 into 10%, 600. Then 400 and 10% of 2,000, 200. Okay. The partnership recorded a draft profit of 5,100,000. They're saying drafted profit. That means this profit is wrong. We'll see why. PL has paid 300 for current year expense of the partnership from his personal money, but it has not been recorded in the account. Okay. A expense of 300 of the business was paid by PL using his personal money. Now, that is an expense of the business, right? That should be deducted from the profit. So, drafted profit is given as 5,100,000. PL has paid the expense of the business and it has not been recorded. So you can deduct that expense from your profit 300 and get the corrected net profit as 4,800. Okay. And see, we have to debit the 300 to the profit and credit it to the partner's account. Now, PL has paid 300 from his personal money, right? That will be, we have to add it to his current account. We have to pay it back to him later. So you can say expense in PL's column 300. Okay. Then what we can do, we can share the profit. Now corrected net profit 4,800,000. From that we can deduct the partner's salary. Partner's salary totally 800 plus 800 plus 800. That is 2,400 for all three partners. 2,400. Then interest on capital. Uh, 600 plus 400 plus 200. 1,200. Then if you deduct these two from your profit, you can get your distributable profit. Distributable profit will be 1,200. So what is their profit sharing ratio? PL, Lal and Neil carried out the partnership sharing profit loss equally. So this profit of 1,200, you have to divide it equally between Lal, PL and Neil as 400, 400 and 400. So you can say here profit share 400, 400 and 400. Okay. So next what is happening? Neil retired from the partnership on this date. The goodwill was given, okay. Before that, now we need to transfer Neil's current account balance to the capital account if he's retiring, right? So we'll total this 800 plus 800 plus 600 plus 300 plus 400. That is 2,900. Then Lal 600 plus 800 plus 400 plus 400, 2,200. And Neil 400 plus 800 plus 200, that is 400 plus 800 plus 200 plus 400, 1,800. 2,900, 2,200, 1,800. For PL and Lal, you can take the BCD 2,900 and 2,200. Neil's balance you can transfer to the capital account 1,800. Okay. So you can transfer this amount to the capital account saying current account. Okay. You can transfer to the current account saying 1,800. Okay. Now, how did I get the corrected net profit? You mean this one, right? Why did I deduct 300 here? PL has paid the expense of the business from his personal money that has not been recorded. They have not recorded a particular expense of 300. So you have to deduct that expense of 300 from the wrong profit they have calculated, right? So wrong profit they have calculated is 5,100,000. From that, if you deduct the expense of 300, you get the corrected profit as 4,800,000. Did you understand that? That was a doubt, no? Okay. Now you have to do the goodwill adjustment. Old ratio debit, new ratio, sorry, new ratio debit, old ratio credit. The goodwill is given as 1,200,000. New ratio only PL and LAL are there. They are sharing profit and loss equally. New ratio debit 600 and 600. 1,200 if you divide equally between PL and LAL, 600, 600. Old ratio credit. Old ratio was also profit and loss shared equally, right? And that will be 400, 400 and 400. Now you can balance it off and transfer Neil's amount to a loan account. And for PL and LAL, you can find a closing balance. So 6,400, 4,400 and 4,200. 6,400, 4,400, 4,200. Neil's loan account balance will be 4,200. Then PL's and Lal's closing balance will be 6,400 minus 600, 5,800. And Lal 4,400 minus 600, 3,800. So then now you can find the answers. Current account balance of PL will be 2,900, answer number 4. Capital account balance of PL and loan account of Neil. PL's capital account is 5,800. Neil's loan account is 4,200. 5,800 and 4,200, answer number 2. Okay. Then that is done. Next one. Okay. Total income, total expense, other comprehensive income, and total comprehensive income. So first of all, how to do this? Total comprehensive income equals total comprehensive income equals total income minus total expense. Okay. Now in income, sales is a income. Sales 4,500. Gross profit is 2,100. Then the expense between that is the cost of sale, right? Sales minus cost of sale only gives you gross profit. Now, if the sale is 4,500 and gross profit is 2,100, then how much is the cost of sale? Cost of sale will be 2,400. So this cost of sale you have to recognize as expense. Cost of sale 2,400. Then they have given other income. Other income is given as 600. Other income 600. Then between other income and profit before tax, you have your operating expenses. Your total period cost, operating expense. Profit before tax is 1,200. And how much will be your operating expense? You can reverse 1,200 minus 600 minus gross profit 2,100. Your operating expense will be 1,500. So you can say, you can recognize the operating expense as expense. Operating expense 1,500. Okay. Then the difference between your between profit before tax and profit after tax is your income tax. And how much is the income tax amount here? The difference is 400. That means your income tax is 400. That is the expense. Income tax 400. Then a surplus of 700,000 has been arisen from revaluation of machinery of the company for second time on 31st March 2023. So during this year, we have got a revaluation surplus. So that is a income surplus 700. Okay. The profit for the current year of the company has been calculated without considering this revaluation. The deficit recognized on the first time revaluation of machine was 300,000. So the deficit of the first time revaluation deficit, you have to deduct on the other expense. Now, since they have not considered this revaluation, they have not recorded this. Okay, we'll adjust that with the other comprehensive income. Now, how much is your total income? Total income is 4,500 plus 600 plus 700, that is 5,800. Total expenses are 2,400 plus 1,500 plus 400, that is 4,300. Then your total comprehensive income will be 5,800 minus 4,300, that is 1,500. Now you can divide this. You can divide this as your profit after tax and the other comprehensive income. Now, during the year, you have gained a surplus of 700 due to revaluation. Last time there was a deficit of 300. So the last time deficit should be adjusted under other expense. Then how much of the surplus can you record under OCI? 700 minus 300. Only 400 you can record under other comprehensive income. Then how much will be your profit after tax? That is 1,500 minus 400. Your correct profit after tax after considering the revaluation will be 1,100. This profit after tax is wrong. Okay, so then total income 5,800, total expense 4,300, that is answer number 5. Other comprehensive income 400 and total comprehensive income 1,500, that is answer number 2. Okay, then the 18th one. Which of the following statement are correct as per LKAS 2? The cost of inventory should always be calculated based on cost formula. Now, cost formula means FIFO and WACC. Okay. LKAS2 is just recommending it is better for you to calculate your cost of inventory based on a cost formula by using either FIFO or WACC. But it is not mandatory. So should always be calculated? No. Okay, there are a few other methods to calculate the cost of inventory which are not there in your syllabus. Okay, so for example, like there's something called retail method. Okay, likewise, there are methods other than the cost formula to calculate your cost of inventory. Therefore, this is wrong. The loss arising from written down value of inventory, that means the stock written off value, if your net realizable value is low, should be recognized as expense in the period it occurred. Correct, right? The NRV, if the NRV is lower, the stock written off value we will record as an expense, right? So B is correct. Then C, the assets which are held for sale in the ordinary course of business are considered as inventory. Correct, right? Inventory are the items. Now, the items that we keep to sell in our business, the trading goods, we consider as inventory. So, B and C are correct. That is answer number 4. Then, 19th one. Janaka PLC was incorporated on 1st of April 2022. So, it's a newly started business. The company is fully financed through ordinary share capital. The following information has been extracted from the books of account. What are they asking? What is the amount of net cash flow? Yes, Amri, give me a minute. Here, Amri. Third one is the fourth one. 4 and 5, 3 and 4. Okay. 4, 3 and 4. Those are the answers. All right. Then now they are asking what is the amount of net cash flow generated from operating activity. So the cash sale amount we will take under operating activity, right? Cash sales is the operating inflow. Cash sales 1,500. Credit sale is given as 3,600. We are not taking credit sale. We have to get the cash received from debtor. Now see, your credit sale amount is 3,600 and your closing debtor amount they have given as 900. That means how much have your debtor paid during the year? There won't be any opening debtor because it's a newly started business. During the year, you have made a credit sale of 3,600 and the closing debtor balance is 900. That means during the year, your debtor has paid 3,600 minus 900, that is 2,700. So you can say receipt from debtor, receipt from debtor, that's operating activity, 2,700. So here you don't have to waste time drawing a T account. If you all want, I can draw and show debtors account, credit sale amount 3,600, closing debtor balance is 900, and when you balance off, you will get the cash received from debtor as 2,700. Okay. Payment to trade creditor that you will deduct. That's the outflow. Payment to creditor 1,600. Then operating expenses. Operating expense includes depreciation of 500. And they are saying there is no any prepaid or accrued expense. Then if the operating expense is 1,100 and it includes depreciation of 500, then how much is the operating expense paid in cash? That is 600. So 600,000 is operating expense paid minus operating expense paid, that is 600. And then income tax paid is 200 minus income tax paid 200. You can get the net cash flow from operating activity. 1,500 plus 2,700 minus 1,600 minus 600 minus 200, that is 800. Wait, did I miss anything? Give me a minute. 1,500 plus 2,700 minus 1,600 minus 600 minus 200, that is 1,800. Okay, 1,800. So the answer is the first one. First one is the answer. Then 20th one. AMA PLC purchased the machine costing 3,600,000 on 1st of April 2020. On this date, the useful life and residual value of the machine were estimated as 8 years and 400,000 respectively. The useful life and residual value of the machine was reviewed on 1st of 4th, 2022. So at the beginning of the current year, they have changed their useful life and residual value itself. Accordingly, the originally estimated useful life and residual value of the machine were revised as 6 years and 600,000 respectively. So now, if anything of the machine is changing, you have to follow the this equation to find your new depreciation. Depreciation equals, okay, if there's any change in the useful life, residual value, or any modification cost, you have to use this equation. Cost minus accumulated depreciation plus modification cost minus new residual value divided by remaining useful life. Don't forget this. Remaining useful life. Okay. Now, the cost of the PPE is 3,600,000. How much will be the accumulated depreciation before the change? We have to calculate. Now, here we purchased on 1st of April 2020. We are making the change to useful life and residual value on 1st of April 2022. So the gap between the purchase date and the change is 2 years. Now we have to calculate the accumulated depreciation for 2 years. That will be the cost. How do you find normal depreciation? Depreciation equals cost minus residual value divided by Useful life next. Originally the cost was 3,600,000. Residual value was 400. Useful life was 8 years. The earlier depreciation is 3,600 minus 400 divided by 8. That is 400. Okay, so 400 into 2 years, the accumulated depreciation will be 800. So minus 800 plus there is no any modification cost here. New residual value is 600. Divide by remaining useful life. Here they are saying in this question, the originally estimated useful life. What was the originally estimated useful life earlier? 8 years. They are saying this originally estimated useful life has been changed to 6 years. Now this 6 years is not the remaining useful life, okay? Here they are saying this originally estimated 8 years have been changed to 6 years. So the useful life is 6 years. Already 2 years is gone. We depreciated for 2 years. Then what will be the new remaining useful life? That is 6 minus 2 years. 4 years is your remaining useful life. And how much will be the new depreciation for the 3,600 minus 800 minus 600 divided by 4? That is 550,000. Answer number 4. Answer number 4. Okay. Then 21. The financial statement of Sumudhu PLC for the year ending 31st March 2023 were authorized for issue by the director on 20th of May 2023. A court order was given on 1st of May 2023 to pay rupees 600,000 as a compensation in relation to a case filed against the company. Okay. A provision for compensation of 800 has been recognized for this case. Alright. Now here first of all, what are they asking? What is the correct profit after making the relevant adjustment? Now here they have given a drafted profit as, they have given a drafted profit of 3,500,000. Drafted net profit 3,500,000. Okay. Now what has happened? We have already provided a compensation provision of 800,000. After the reporting date, on 1st of May, we are getting a confirmation from the court saying you have to pay compensation of 600,000. Okay, so the court order was given on 1st of May. Okay, and the directors authorized the financial statements on 20th of April. Therefore, this is the event after reporting period before the approval date. So you have to adjust this. So the actual provision we have to pay is 600. We have recorded 800. So we have recorded 200 extra. Okay, we have recorded compensation of extra 200. Then to reverse it, you have to add it back to your profit plus compensation. You have deducted extra, right? Extra 200. You have to add 200 back. Next one. A debtor of the company was declared bankrupt on 10th of May 2023. The amount receivable from this debtor as at 31st March 2023 was 600,000. Okay, so he went bankrupt before the authorization date and he was there as at the reporting date. Therefore, it is the adjusting event. So minus bad debt, you can record it as bad debt 600. Then your corrected profit will be 3,500 plus 200 minus 600, 3,100. That is answer number 2. Okay. Then 22. Which of the following statements are correct as per LKS 37? Provision, contingent liability, and contingent asset. A. Contingent asset should not be recognized in SOSP. Correct. We don't record contingent assets in a SOSP. Provision should not be recognized for future operating loss. Correct. For future operating loss, that means you can't predict and say next day I'm going to incur a loss, and you can't allow a provision for that. Okay. For future operating losses, you will not provide provision. So B is correct. C. Contingent liabilities are recognized in the statement of financial position only when there is a possible obligation. Wrong. Contingent liability is already possible obligation. We don't record contingent liability in our SOSP. We show it as a note to the financial statement. So the correct statements are A and B only. Answer number 4. Then 23. Quick asset ratio. Alright. Quick asset ratio is quick asset is to current liability. The current liability is given as 7,500. They have given the current asset. Okay. So current asset includes inventory and prepaid expense. How do you find quick asset? Quick asset equals to current asset minus prepaid expense plus closing inventory. Current asset is given as 15,000. Prepaid expense 6,500. Sorry, 2,500. Closing stock is 6,500. Then your current asset will be 15,000 minus 9,000. That is 6,000. Then quick asset is 6,000. Then your quick asset ratio will be 6,000 divided by 7,500. 0.8 is to 1. Then how do you find your inventory residence period? Inventory residence period equals to average inventory divided by cost of sale into number of days in the year. They have given us 360. Average inventory equals opening inventory plus closing inventory divided by 2. Opening inventory is given as 5,500. Closing inventory is 6,500. Add those two and divide by 2. Average inventory will get as 6,000. Divided by cost of sale is given as 36,000 into 360. Inventory residence period will be 6,000 divided by 36,000 into 360. That is 60 days. So the answer is 0.8 and 60 days. Answer number 1. Then 24. Which of the following statements are correct in relation to management accounting reports? Management accounting reports are prepared for internal stakeholders of a firm. Correct. It is not compulsory to follow accounting standards in preparation of management accounting reports. Correct. In management accounting, you don't have to follow accounting standards. C. Management accounting reports are prepared whenever a need arises to manager. Correct, right? Management accounting we prepare on demand by managers. When the manager wants information, we'll have to provide. That is correct. Management accounting reports provide only forecasted information. Wrong. We provide both historical and forecasted information. So answer is A, B, and C. Answer number 2. 25. 25, they are asking the total production cost per unit. So direct material cost per unit is 90. Direct labor cost per unit is 50. Then the prime cost per unit is 140. And for that, variable product, you should add the production overheads. You have variable production overheads per unit as 60. And you will also have to find the fixed production overhead per unit. Total production overhead total fixed production overhead is given as 1750. Give me a minute. Okay, sorry. So total fixed production overhead is given as 1,750,000. For a year, you're producing 25,000 units. Then the fixed cost, the average fixed cost per unit will be 1,750,000 divided by 25,000 units, that is 70 rupees. Then production cost per unit will be 140 plus 60 plus 70, that is 270 rupees. Answer number 3. Answer number 3. Okay. Then question number 26. Which of the following statements is correct as to overheads of a manufacturing company? Okay, overheads. Commonly incurred production overheads are apportioned to the cost centers. Commonly incurred overheads. That means, for example, you can take rent. Now, in a factory, you might be paying rent for an entire floor, and that floor you might have divided as production department, storage department, or assembly and finishing department. Okay, but you are paying only one rent for that entire building. So what you can do, this is a commonly incurred expense. You will divide it based on the floor area, right? So commonly incurred production overheads are apportioned to cost centers. You will divide it to the cost centers based on a relevant basis. Like electricity, you will divide based on kilowatt hours. The rent you will divide based on floor area, likewise. So A is correct. B, total overheads are the difference between total cost and total production cost. No, it's either total cost equals to production cost plus non-production cost, or total cost equals to prime cost plus total overhead. Total overheads will have production overheads plus non-production overheads. Okay, so total overheads are the difference between total cost and total production cost. Wrong. Total overheads is the difference between, you can tell, prime cost and total cost. So second one is wrong. C, overhead absorption rate is calculated based on only machine hours and labor hours. Wrong. Overhead absorption rate can be calculated based on machine hours, labor hours, direct material cost, direct labor cost, then as a percentage of prime cost, right? There are various methods to calculate the overhead absorption rate. These are not the only two methods. So the answer is the first one. Only the first one is correct. Okay. Then 27. Which of the following statement is correct in relation to CVP analysis, the marginal costing? At the break-even point, total sales equal to total fixed cost. Wrong. At BEP, total contribution equals to total fixed cost, not total sales. Total contribution equal total fixed cost. A is wrong. B, at the break-even point, total variable cost and total fixed cost are recovered fully. So at break-even point, what does break-even point? The point at which we can cover our total cost, okay, without incurring a profit or loss. So at break-even point, total variable cost and total fixed cost are recovered fully, means total variable cost and total fixed cost means your total cost, right? So it's correct, right? At break-even point, your total cost is fully recovered. See, the contribution and profit are equal to each other for every unit sold beyond the break-even point. Correct. Okay. So, sales minus Variable cost will give you contribution. Contribution, if you minus total fixed cost, you will get the profit. Okay. At break-even point, your total contribution equals to total fixed cost. Okay. So at break-even point, all your costs are covered. So whatever the units you sell beyond the break-even point, okay, and you earn a contribution beyond the break-even point, your total fixed cost is already covered, right? So whatever the contribution you earn beyond the break-even point will go as your profit. So remember, change in contribution will be equal to the change in your profit. So C is correct. So the answer is B and C, answer number 4. Answer number 4. Then 28. Total production cost per unit, total cost. Okay. A company is planning to produce two types of products, A and B. The budgeted information relevant for the first year of operation as follows. Okay, what are they saying? To find the production cost per unit and total cost per unit. Here they are saying the production overheads and non-production overheads are absorbed based on labor hours. Even the production overhead as well as non-production overhead, both are absorbed based on labor hours. Then we'll find the overhead absorption rate. Overhead absorption rate of production cost will be total production overhead is 416,000. Total labor hours is 52,000. Then the overhead absorption rate will be 416,000 divided by 52. That will be rupees 8 per labor hour. Okay, this is your production cost or what? OAR. Then the OAR of your non-production cost. Non-production cost. That will be 208,000 divided by labor hours 52,000. 208 divided by 52 will give you rupees 4 per labor hour. Now here 28 is saying to find the estimated total production cost and total cost of product A. So product A, the total prime cost is 280,000. Now we need to find for one unit, right? Product A, prime cost. Okay. Prime cost for one unit, 280,000 divided by 8,000 units. Prime cost for one unit is 35. Okay. Then overheads. Production overhead. All right. For 1 hour, production overhead is 8 rupees. Okay. To produce one unit of A, you have to spend 5 labor hours. And the production overhead will be 5 hours into 8 rupees per hour. That will be 40. Then the production cost per unit will be production cost per unit will be 75,000. So how do you find the total cost? For the production cost, you have to add the non-production overhead. Non-production overhead is rupees 4 per labor hour into, to produce one unit, you are spending 5 hours. Then how much will be the non-production overhead? 20. Then you can get your total cost as 75 plus 20, that is 95. Total cost is 95 for product A. So total production cost 75, total cost 95, answer number 2. 29. Estimated selling price per unit of product B. So same thing. Now we will here see the selling price of a product are determined by adding 25% on total cost. And we will firstly have to find the total cost of product B, right? Guys, can you give me like 5 minutes? I'll be back. So 29. So for product B, we have to find the selling price, right? How do you find that? For product B, the prime cost for product B will be total prime cost for product B 120,000. You are producing 2,000 units. Then the prime cost for 1 unit will be 60 rupees. 60 rupees. Then production overheads will be, we find the OAR as 8 per labor hour. To produce 1 unit of B, you need 6 labor hours. And the production overhead is 6 hours into 8 per hour. That will be 6 into 8, 48. Then prime cost plus production overhead will give you your production cost. Production cost will be 60 plus 48, 108. Now here what are they saying? They are saying to calculate the selling price on total cost, not production cost. And for the production cost, you have to add your non-production overhead as well. So non-production overhead is 4 per labor hour we found. So labor hours required to produce 1 unit of basic into 4 per labor hour. That will be 24. Then your total cost will be 108 plus 24, that is 132. For this total cost only, you have to add a profit of 25%. 25% of total cost will be 33. So then you can find your selling price as 165. Answer number 4. Okay. Then the 30th one. They have given project X and Y, and yeah, they have given a few statements. Net present value of project X is 916,000. How do we find that? See here, they have given the present value from year 1 to 5. How do you find the net present value? From the present value of year 1 to 5, if you deduct the initial cash outflow, you can get the net present value. So net present value equals present value of net cash flow from year 1 to year 5 minus initial net cash flow. Present value of net cash flow of year 1 to year 5 is given as 9,566 minus initial net cash flow will be purchase price of the machine plus transportation and installation cost of the machine plus initial working capital requirement. And what will be the total initial cash outflow of project X? 8,250 plus 150 plus 250, that is 8,650. Then if you deduct the initial cash flow 8,650, how much will be your NPV? That is 916. Therefore, statement A is correct. B. The initial cash outflow of project Y is 7,650. Is that correct? Purchase price 7,525. Transportation and installation 125. Initial working capital 825. Then 7,525 plus 125 plus 325. That is 7,975. So B is wrong. Initial cash outflow of project Y is 7,975. C. Present value of net cash flow from year 1 to 5 of project Y is 8,923,000. So we'll find it out using the same equation. NPV equals present value of net cash flow of year 1 to year 5 minus initial net cash flow. And how can you find the present value of net cash flow from year 1 to year 5? That will be NPV minus the initial net cash flow. Okay, Now, in this question, they have given the NPV. They have given the NPV as 948 minus initial cash flow we found as 7975. Wait. No, it should be NPV plus initial net cash flow. Initial net cash flow, if it goes to other side, it will be plus, right? 7975. 7975 plus 948, that is 8923. So that is correct. C is correct. Answer is A and C. Answer number 3. Okay. Here what I want to tell was, I'm not feeling a bit well now. Is it okay if I'll send the recordings? I'll try to pre-record when I'm a little bit okay, and I'll send the remaining 20 questions. I think I'll have to end the class here. Okay. I'll try to send that remaining 20 questions soon. That's what I took a break calls in the middle. Okay. All right. Then I'll end the class now. I'll send that soon. Thank you for joining. Recording in progress. So then starting off with question number 31. State whether each of the following statement is true or false in relation to the general purpose financial statements as per LKAS 1. Okay. So prepare in compliance with relevant accounting standard. Yes. Now here they are talking about general purpose financial statement, right? So financial accounting, it is prepared based on accounting standards. That is true. Then prepare to meet the needs of users who are not in a position to require a firm to provide tailor-made, customized information. Correct, right? So who are the people not in the position to require tailor-made or customized information? The external parties. Okay, external parties such as the resource providers, they can't get customized information from the business. Okay, for them, we are providing the general purpose financial statement. True. Okay, the internal parties like managers, they can get tailor-made information. Those are management accounting information. C. Prepare based on the management assessment about the going concern of a firm. True. So the main assumption of preparing general purpose financial statement is going concern. If the firm is going concern, they will divide their assets and liabilities as current and non-current. If not, they just record it as current. That is true. Provide information about operating result of a firm on both accrual basis and cash basis. So to find the operating result in accrual basis, we prepare a statement of profit or loss. To find the performance of the business in cash basis, we prepare the cash flow statement. Therefore, that is true. 32. State the net impact with value of each of the following transactions on the amount of equity in the accounting equation of a trading business. Okay. Payment of a loan installment of 1,250, including 600,000 interest. So the interest is an expense that will reduce your equity. So you can say here decrease, or you can just simply say D as well because they are giving that as the option. It will decrease by the interest amount 600. Here you can write it in thousands. Purchase of goods on credit with a list price of 2,500 subject to a 10% trade discount. So the purchase price, the final purchase price after deducting the trade discount of 10%, that is 10% trade discount is 250. So 2,500 minus 250 is 2,250. So the purchase price of 2,250 will increase your inventory and increase your creditor. So there is no change in your equity. No change. You can say 0 or put a dash. Okay. Then 33. Identify the following. Balance as per bank statement and adjusted balance of the cash account. So here they have given the opening cash balance and closing cash balance. And they have given the summary of the bank statement. And they are saying direct remittance and standing orders are recorded in the cash account after the bank statement is received and further a check of 200,000 received from a customer and deposited in the bank has been dishonored. No adjustment is made in the books of accounts for the dishonored check. Okay. Now, first of all, they are asking for the balance as per bank statement. Now, here they have given the summary of the bank statement, right? You can directly find it. Credit balance of the bank statement 200. So, for the bank statement, credit balance means for us it's a debit balance. So, it's a positive balance 200. Realized check you will add 2200. Presented check you will deduct 1500. Direct remittance you will add. Standing order you will deduct. Then you can find your balance, your closing balance of the bank statement 200 plus 2200 minus 1500 plus 300 minus 50, 1150. So balance as per bank statement 1150 and it's a positive balance. So in the bank statement it will be a credit balance. For us it's a debit balance. Okay. Adjusted balance of cash account. So for that you need to prepare adjusted cash control. Adjusted cash control. Closing cash balance, which they have calculated before considering the bank statement, is 800. The closing balance they have calculated is 800. You have to take that as the opening balance, BBF 800. And now record the direct remittance 300. Direct remittance 300. Standing order 50. And dishonored check. The check received from a debtor is dishonored. So when you receive a check from debtor, it will be debited. Now, when it is dishonored, you will credit it. Dishonored check 200. Now, when you balance off, you can find the adjusted cash balance. 1100 minus 250. Balance carried down will be 850, right? 850. Okay. Then you can say, and now this BCD will come to the next month as BBF 850. So adjusted balance of cash account 850, that's a debit balance. Okay, write the double entries to record the following. Dishonor of 200,000 check. Now that was a debtors check dishonored, right? So debtors will again increase. They will have to pay you back. Debtors control account will be debited by 200,000 and cash control account credited by 200,000. B. Standing order payment loan installment of 50,000 including 30,000 interest. So interest expense debit 30. Then the loan amount is 20. Bank loan debit 20. Cash control credit 50. 35. Complete the following statements with the most appropriate accounting concept. The blank concept provides the basis to recognize debtors and creditors in the financial statement, that is the accrual concept. Based on the accrual concept only, we recognize debtors and creditors. The dividend paid to shareholders is presented as a distribution of profit. So paying dividend to shareholders is based on business entity concept. The blank concept provides the basis to recognize provision for liabilities with uncertain timing or amount, the prudence concept. The revaluation of property, plant and equipment at the fair value is an example for the deviation or violation from historical cost concept. Okay, then 36. Complete the following sentences or equation in relation to the preparation of financial statement of a manufacturing business. Cost of raw material loss due to fire is recognized in the, so if there's a raw material destroyed, you have to remove it from the raw material under prime cost and you should record it as a other expense in the income statement or statement of profit or loss. You can say income statement. The work in progress inventory is valued at either prime cost or total production cost. So at prime cost, we did a question previously in the MCQ where the work in progress is recorded at prime cost. So work in progress can be calculated under prime cost or under total production cost. Then opening raw material inventory plus raw material purchase minus raw material closing raw material will give you your raw material consumed amount. How much is the raw material you have actually used? The opening finished goods inventory plus total production cost minus closing finished goods will give you cost of sales. Cost of sales. 37. Samagi Sports Club had 300 members as at 1st of January 2023. The monthly subscription for a member is 1000. Information relevant to the subscription is presented below. So you can prepare a subscription account. Subscription account. Opening, they have given opening advance that will go to credit side 30. Opening asset, opening receivable 40. There were 30 members in arrears as at 1st of January 2023. Okay. And as at the opening date, there were 30 members in arrears. Out of them, 20 members paid their arrears for December and the full subscription for the current year during the year 2023. Now, there were 30 members in arrears. Out of them, 20 members, they paid their arrears, which they had arrears for December last year. They paid that. And also the subscription for the full year, this full year also, they have paid. Okay. The balance 10 members in arrears. Okay. Now, 30 members were in arrears. Out of that, 20 paid. The balance 10 members in arrears neither paid their arrears for last 2 months of the year 2022. Those 10 people had to pay for the last 2 months of last year also. They have not paid it yet. How much will that be? 10 members into 2 months into 1000 per month. That is 20,000. Okay. Nor the full subscription for the year in 2023. This year's entire amount also they didn't pay. That will be the 10 members into this year has 12 months. 12 months into 1000 per month, that is 120. So the total receivable for this year will be 140 from them. And they are saying all the subscription received in advance is relevant for the year 2023. All this opening advance amount is relevant for this year. All other members have paid their subscription fully. That means your closing arrears will be only this amount. All the other members have paid everything. The closing arrears will be 140. BCD 140. And there is no sign of any closing advance. Closing advance will be 0. Then the cash amount you can put in the credit side. Cash, debit, subscription, credit. Income and expenditure amount for the amount in the debit side. How can you find the for the year amount? There are 300 members into 1000 per month into full year 12. The for the year amount will be 300 into 12, 3600. Then you can balance off and find out how much is the cash received from members. 3640, 3640 minus 140 minus 30, 3470. So subscription receivable as at 31st December is 140,000. Total subscription received for the year ending 31st December 2023 is 3,470,000. Okay. Then 38. State whether each of the following statement is true or false in relation to partnership. A partnership cannot be carried out without a written agreement. That is false. We can carry out a partnership without a written agreement if we have a verbal agreement or an implied agreement. If they say a partnership cannot be carried out without a agreement, that is correct. Okay, we should have either one of the agreements, written, implied, or verbal. B. The maximum number of partners is limited to 20 members as per partnership ordinance. Wrong. That is as per the Companies Act. Companies Act is only telling us the limit for the partnership. C. The goodwill of a partnership is suggested only when a new partner is admitted. False. Goodwill is suggested when a new partner joins, when an existing partner leaves, when the profit sharing ratio is changed. Right? There are several situations. As per the section 24 of the partnership ordinance, the partners are entitled to receive 5% interest per annum on the loans granted by them in addition to the capital. Correct. True. Okay, if the partner gives a loan, the existing partner gives a loan in addition to the capital he provided, he is entitled to get a 5% interest on that loan. Then 39. Ravi and Sandhu carry out a partnership sharing profit and loss equally. Following information is extracted from the current account of the partners. Profit share of Ravi. Now, how do you find the profit share? They have given the opening balance, partner salary, um, salary paid amount, and the interest on capital and closing balance. Now, how can you find the profit share? You can reverse 5,100 minus 800, then minus 1,000 will be plus 1,000, minus 1,400 minus 3,000. The profit share of Ravi will be 900. Now here, Ravi and Sandhu are carrying out the partnership business by sharing profit or loss equally, right? And Sandhu also, you don't have to reverse and find again. That will be 900. Okay. Then the profit share, when they say profit share of Ravi, they are asking for this. The distributed profit to Ravi is 900. Then total profit appropriated to Sandhu. When they say total profit appropriated to Sandhu, that is the partner's salary plus interest on capital plus the profit share. Salary 1,200, interest on capital 400, and profit share 900, that is 2,500. Then the profit of the partnership. So profit equals interest on capital plus salary plus profit share. Interest on capital for both the partners are 800 plus 400, that is 1,200. Partner's salary 1,400 plus 1,200, 2,600. And profit share 900 and 900, 1,800. Then the total profit of the partnership is 5,600,000, 5,600. Okay. 40th one. Complete the following sentence in accordance with conceptual framework for financial reporting. The financial statements are normally prepared on the going concern assumption. Going concern assumption. The right that has the potential to produce economic benefit is defined as economic resource, not just resource, economic resource. The two factors that are considered when selecting a measurement basis are, so when you are selecting a measurement basis, you need to consider if it provides relevant information, relevance, and are we providing it with faithful representation, faithful representation. Okay. Then 41. State whether each of the following statement is true or false relating to ordinary share of public limited company. The right issue of share lead to an increase in both equity and asset. So when you provide right issue, you're getting cash, right? So on one hand, your equity, ordinary shares are, your equity is increasing, and on the other hand, your cash is increasing. So asset will increase. That is true. The cash received with application of a share is directly credited to share capital account. No, we first of all we have to credit it to the share issue account, and after that return whatever the excess received amount, and then only we will put the amount we actually issued to the share capital account. That is false. The allotment of shares should always be done on the pro rata allocation basis. False. What is pro rata allocation basis? We are dividing the shares among the shareholders based on a ratio. Sometimes, let's say we issue 1,000 shares, but we have received cash for 2,000 shares. Pro rata allotment basis means now we will accept only the amount we issued. So how the pro rata allotment will work? If a person applied for 2 shares, he will get 1 share. That's how pro rata works according to ratio. It doesn't always have to be like that. Sometimes you can just get it first in, first out. Whoever applied last, you can totally chase them away. You can select which method to use. Then D. The capitalization of reserve lead to an increase in number of shareholders. No. Capitalization of reserve means you're giving free shares to the existing shareholders. So the number of shareholders won't increase, that is false. Then 42. The following information relates to raw material used in apparel manufacturing business. Cost. They are asking the cost as per the closing raw material, right? Closing raw material as per the FIFO method as well as the WAC method. So first of all, FIFO. Quantity into unit price equals to value. Opening inventory 500 meters into purchase price 2000 per meter, that will be 1 million. Issued 300 meters. Okay, wait, first of all, and then you can take all the purchase. Then purchase again 400 meters at 2500. That is again going to give you 1 million. And totally you have 900 meters of fabric at 2 million rupees. Okay, so now you're issuing 300 on 10th and you're issuing 360 on 31st. Then totally how much are you issuing? 660. Then how much will be there in the closing stock? 900 minus 660, 240 will be there. So based on first in, first out, the inventory you purchase first will go out first. Then the balance 250 will be there from the last stock price. So the closing stock will be 240 multiplied by 2500, because this entire 500 will go out, and after that another 160 will go out from here. Then only 240 will be remaining from this stock that you purchased on 20th. So closing stock based on FIFO will be 240 mixed into 2500, that is 600,000. Cost as per FIFO method 600, that into writing 1000. Then based on WAC method, opening stock WAC, opening stock 500 into 2000, that is 1 million. Then issue 300 units into 2000. From this, we are going based on average price, right? 300 into 2000, 600,000. Then the balance will be 400,000. 200 units, the average price of it is still 2000. And then purchase 400 meters into 2500, that will give you 1 million. Now you have 1,400,000 worth of inventory. And 600 units, 600 meters, then the average price will be 1,400,000 divided by 600 meters, that will give you 233, 2333.33. Okay, now you're issuing 360 meters. Okay, you're issuing 360 meters. Then how much will be the rupee value of that? Okay, not to get a decimal answer, what you can do it like this: 1,400,000 divided by 600. Okay, and straight away multiply that by 360, and you will get the answer 840,000. Okay, then the remaining inventory value will be, even if you get a decimal, you can round it off to nearest whole number or something, they will give you the mark. So that will be 1400 minus 8, 40. 560,000. That is 240 units. Okay. So closing stock based on WAC method will be 560,000. Based on FIFO 600,000. Next 43. State whether each of the following situation is a change in an accounting policy or a change in an accounting estimate. A. The change of depreciation method from straight line method to reducing balance. Depreciation method is a estimate change. Estimate change. The change of measurement basis of PPE from cost model to revaluation model. That will be a policy change. The change of useful life is estimate change. The change of cost formula used to measure the cost of inventory from WAC method to FIFO method, that is a policy change. 44. The following information has been extracted. They have given the long-term loan value, interest expense amount, and income tax expense for the year. The return on equity ratio and debt to equity ratio are given 20% and 60%. Now, how can you find the equity? You can find the equity to the debt to equity ratio. Debt to equity ratio equals debt capital divide by, okay, they have given the answer as a percentage, right? Then you should calculate debt capital or equity capital into 100. They have given the debt capital ratio as, debt to equity ratio as 60%. Debt capital means the long-term loan, that is 12,000. Equity we don't know, into 100. Then equity equal 12,000 divided by 60 into 100. That will give you 12,000 divided by 60 into 100. That will give you 20,000. Equity 20,000 in thousands. Here we put the values of in thousands, right? Equity will be 20 million. Then profit for the year you can find from the return on equity ratio. That will be profit for the year divided by equity capital into 100. Return on equity ratio is given as 20%. Profit for the year we don't know. Equity we found as 20 million into 100. Then the profit will be 20 into 20,000 over 100. So simply the profit will be 20% of the equity, right? Return on equity is 20% means your profit. Profit is only return on equity. So your profit is 20% of your equity. So 20 over 100 into equity 20,000, that will give you 4,000. 4,000. So your return profit for the is 4 million. Then interest cover ratio. Interest cover ratio will be profit before tax plus interest divided by interest. Profit before tax amount will be, now profit for the year, that is profit after tax is 4 million. Then profit before tax will be profit after tax plus the income tax. So that is 4,800,000. 4,800,000 plus the interest expense is given as 1,200 divided by the interest 1,200. Interest cover ratio will be 4,800 plus 1,200 is 6,000 divided by 1,200. That is 5 times. So the interest cover ratio is 5. Okay. Then 45. The following information relates to a raw material used in production process. They're saying to find the EOQ. Economic order quantity equals square root of 2 into annual demand into cost per order divided by holding cost per unit. 2 into annual demand is 120,000. You should find a cost per order. Here they have given the annual ordering cost is order size is 3,000. So that means first of all, how much is the number of orders? Number of orders equals annual demand divided by ROQ. Annual demand is 120,000 divided by ROQ means how much units are you ordering at a time. So here order size is 3000 units. At a time you are ordering 3000 units. Then totally for the year you have to order how many times? 120,000 divided by 3000, that is 40 times. Now this ordering cost is for the 40 orders. Then for one order that will be cost per order 60,000. Total ordering cost divided by number of orders, that is 1500. So into 1500 divided by annual holding cost per unit is 10 rupees. The economic order quantity will be 2 into 120,000 into 1500 divided by 10. Square root of 3 million. Pair up the zeros and the square root of 36 is 6. So that is 6,000 units is your EOQ. Total annual holding cost is EOQ is ordered per annum. Annual holding cost equal ROQ divided by 2 into holding cost per unit. Now here they are saying total annual holding cost. If the EOQ is ordered per order, that means per order you're ordering at EOQ. Then your ROQ will be the 6,000, the EOQ amount. Divide by 2 into 10, that will give you 30,000. 30,000. 46. Amara PLC is a manufacturing company. Its cost details at the operating capacity of 25,000 units are given below. Now we have to find the prime cost, total manufacturing cost, and total non-manufacturing overhead. Okay. So total cost is given. Total cost is given as 7,500,000. Okay. So you know total cost is a combination of variable cost as well as fixed cost Okay. Now total manufacturing overhead is given. Okay. Total variable cost is equal to 60% of total cost. Total cost is 7,500,000. Then variable cost will be 60% of that. How much will be 60% of 7,500,000? That is 4,500,000. Then if variable cost is 4,500,000, the fixed cost will be 1,500,000. Fixed cost will be 1,500,000. Okay. The variable overhead per unit is 70 rupees. The variable manufacturing overhead is 40 rupees. And also they are saying prime cost consists of only variable cost. Now the variable cost you can divide into 3. The same prime cost also consists of only variable cost. Then prime cost is also part of total variable cost, prime cost. Then you will also have manufacturing variable cost, right? So then apart from the prime cost, you will have variable production overhead, and also you will have variable non-production overhead. Okay, and fixed cost you will have fixed production overhead, and you will have fixed non-production overhead. Okay, now here they are saying the variable overhead. So variable overhead means the total production and non-production overhead per unit is 70. Okay, the variable manufacturing overhead is 40. So if variable overhead is 70 per unit and variable production overhead is 40 per unit, the variable non-production overhead is 30 per unit. Okay. And how much will be the total variable production overhead? 40 per unit. You're producing 25,000 units. 40 into 25,000 units, that is 1 million. Variable production overhead will be 1 million. Then variable non-production overhead will be 30 multiplied by 25,000 units, that is 750,000. Then the prime cost will be 4,500 minus 1,000 minus 750. The total prime cost will be 2,750,000. Now here they are saying other thing. Total manufacturing overhead is 2,500. Now total manufacturing overhead means what? The total variable overhead and total fixed overhead. Total manufacturing overhead is 2,500,000. Out of that, the total variable manufacturing overhead is 1 million, which means the fixed manufacturing overhead is 1,500,000. Here, wait, I have made a mistake. The fixed cost is 7,500,000 minus 4,500,000 is, it should be 3 million. 3 million. Sorry, 3 million. Okay. The fixed production overhead is 1,500,000. Then if the total fixed cost 3 million and the fixed production overhead is 1,500,000, the fixed non-production overhead also will be 1,500,000. Okay. Then the prime cost per unit. The total prime cost is 2,750,000 divided by 25,000 units. That will give you rupees 110. Then total manufacturing cost will give you prime cost 2,750, variable production overheads 1 million, and fixed production overheads 1,500,000. Your total production cost will be 5,250,000. 5,250,000. Then total non-manufacturing overheads will be variable non-manufacturing overheads and the fixed non-production overhead. Variable non-production overhead is 750. The fixed non-production overhead is 1,500. Total non-production overheads will give you 2,250,000. 2,250. Okay. Then moving on to the next part, 47. Reorder level of material A. So reorder level equals maximum consumption into maximum lead time. Reorder level of A. So maximum consumption will be, now see, the weekly production varies from 300 to 500 units. Now, the maximum production is 500 units, right? Then 500 into, we need for 1 unit 10 kilograms of A. Then the maximum consumption will be 500 units into 10 kilograms of A for 1 unit. We will need 5,000 kilograms of A, 5,000. Okay, now both are in weeks, right? Weekly production and weekly lead time. So the lead time also is in weeks. So maximum lead time is 4 weeks. Then it will be 20,000 kilograms. 20,000 kilograms will be a reorder level. Then next, B, maximum stock level of material B. Maximum stock level equals reorder level minus minimum consumption into minimum lead time plus reorder quantity. Reorder level of material B is 24,000. Minimum consumption will be 300 units into 8 per unit, that is 2,400 kilograms. Minimum lead time will be 4 weeks plus Reorder quantity 15,000. That will give you 24,000 minus 2,400 into 4, that is 9,600,000 plus 15,000. The maximum stock level will be 29,400 kilograms of unit material B. 29,400. The minimum stock level of material C. Minimum stock level equals reorder level minus average consumption into average lead time. Average lead time. So reorder level of material C is given as 15,000 units minus average consumption. See, average production will be 300 plus 500 divided by 2. Average production is 400. And average consumption of raw material C will be 400 units into 6 kilogram per unit. Average consumption of material C will be 2,400 units. 2,400 kilograms of material C. Multiplied by average lead time will be 5 plus 3 divided by 2. 5 plus 3 gives you 8. 8 divided by 2. Average lead time will be 4 weeks. So 15,000 minus 2,400 into 4 is 9,600. The minimum stock level will be 5,400 kilograms. 5,400. Okay, then 48. The following information relates to the wage of a manufacturing firm. The standard production per month is 800 units. Employees paid 100 per unit up to the standard. And if they produce something beyond the expected 800 units, they will be paid 120 per unit for that extra unit. So we have employee 1, employee 2, and then we have a storekeeper, employee 3. Okay, so employee 1, employee 1, employee 2, no, wait. Employee 1, employee 2, employee 3. So basic salary, basic for the production workers are 800 units. No, they have to produce 800 units into 100 per unit, that is 80,000 rupees. So basic for them is 80,000. And they are paid extra, so they are paid 120 rupees for whatever the unit produced extra. So extra units produced. So when you look employee 1, he have produced 950 units. The standard is to produce 800. So he have produced 150 extra units. For that you will pay 120, 150 into 120. For that he will be receiving 18,000 rupees. Employee 2 have not produced anything extra. Okay. Storekeeper of this firm is paid 1,000 per day and he worked on a daily basis for 25 days. Then his salary will be 1,000 into 25 days, that is 25,000. You can put that under his basic salary. Okay. The monthly traveling allowance of 5,000 is paid for each employee. Allowance 5,000 for each employee. Then what will be the gross salary of each employee? Employee 1, 80, 80 plus 18 plus 5, 103,000. Then here 85,000, 30,000. Okay. Total labor cost will be the total gross salary, total 103,000 plus 85,000 plus 30,000, 218,000 will be your total labor cost. Total direct labor for the production labor, employee 1 and 2, direct labor, 103 plus 85, that is 188,000. Total indirect labor cost will be the storekeeper's salary, 30,000. 30,000. Okay. Then 49. A company is planning to manufacture a single product. The uh, following estimates have been prepared for the month of January and February. Okay. So they have given the prime cost and total overhead and production unit for January and February. And they're telling to find the variable cost per unit. And how should you find that? Quantity and total cost, this method. Okay. Quantity, see here, in January they produce 8,000 units. When they are producing 8,000 units, the cost of production will be, see, prime cost plus the total overheads, that will be 480 plus 520. Total cost is 1,000, so 1 million. 1 million. Then when in February they produce 10,000 units. When they are producing 10,000 units, the total cost is 600,000 and 600,000, that is 1,200,000. Okay. Now the cost will change because of variable cost, right? When the quantity change by changing quantity is 2,000 units, your total cost change by 200,000. You can find variable cost per unit equals change in total cost divided by changing quantity. Total cost is changing by 200,000. Quantity changing by 2,000 units. Then variable cost is rupees 100 per unit. 100 per unit. So variable cost per unit is 100. Then contribution to sales ratio. CS ratio equals contribution divided by sales into 100. So contribution per unit. Now here, estimated selling price is 125. How much will be the contribution? Sales 125 minus variable cost 100. Contribution per unit will be 25. 25. Contribution 25 divided by sales 125 into 100. CS ratio will be 20%. 20%. Then break-even point. Break-even point in unit equals total fixed cost divided by contribution per unit. Now, how will you find the fixed cost? You can substitute to either one of these units and find it. I'll find at 8,000 units. You can say at 8,000 units, total fixed cost will be equal to total cost minus the total variable cost, right? Total cost at 8,000 units is 1 million minus total variable cost will be 100 rupee per unit into 8,000 is 800,000. Then the total fixed cost will be 200,000. Yeah, 200,000. So then total fixed cost 200,000 divided by contribution per unit is 25 rupees. The BEP units will be 8,000 units. BEP 8,000 units. Okay. Then the 50th one. A company is considering to purchase a machine. The expected useful life of this machine is 5 years. Estimated cash flow of this machine are given below. So payback period. Now here in this question they have given net cash inflow per annum 3,300, right? That means every year you are getting the same amount of net cash flow. Then you can find the payback period easily. Payback period equals initial investment divided by annual cash flow. Initial investment will be equal to the purchase price plus the working capital requirement at the beginning of the year. So that will be 9,250,000 initial investment divided by annual cash flow 3,300,000. Okay. Then the payback period 9,250 divided by 3,300, you will get 2.8 years. 2.8 years. Total net cash flow in year 5 at the end of the useful life. So operating net cash flow is 3,300,000. Net cash inflow 3,300,000. Then the working capital can be recovered at the end of the useful life. Then at the year 5, you will be getting back the working capital. Working capital recovery 1,000,000. And the residual value, salvage value means residual value. The residual value you will be getting at the end of the year 5. That means you can sell your machine at the end of the useful life for 1,250,000. Then the total net cash flow of year 5 will be 5,550,000. Okay. Then third one, accounting rate of return based on average investment. ARR equals average profit divided by average investment. Now here, the profit annual cash flow is same for every year, right? Net cash inflow per year 3,300. And the profit for every year also will be same. Now how will you find your profit? ARR is average profit over average investment into 100. Profit equals annual net cash flow minus depreciation. Annual net cash flow is 3,300, 3,300,000 minus. How do you find depreciation? Purchase price of the machine 8,250 plus minus residual value 1,250 divided by useful life 5 years. 8,250 minus 1,250 divided by 5 years. The depreciation for a year is 1,400. So 3,300 minus 1,400, the profit will be 1,900. So annual profit, the average profit will be 1,900. And how do you find average investment? Initial investment, the value of the machine, 8,250 plus the salvage value 1,250 divided by 2, that is 4,750 into 100. So how did I find average investment? Average investment equals initial investment. Actually, here you should take only the initial value of the machine. Initial investment plus residual value divided by 2. Initial investment, the value of the machine is 8,250 plus residual value is 1,250 divided by 2. 8,250 plus 1,250 divided by 2, that is 4,750. Then ARR is 1,900 divided by 4,750 into 100, that is 40%. ARR is 40%. So then done with the 2023 part 1 paper.